Hi there, and welcome to our stock analysis on Apple. They recently reported their third quarter earnings, and what you're getting to see here in this lecture is our three-step process in analyzing a stock. Number one, performing due diligence, getting ourselves familiarized with the quarter by reviewing the press release or the SEC filing. Step number two, we're going to apply our technical skills to come up with a reasonable price target based on different valuation methodologies. And step number three, formulate our own investment thesis supported by our price target. So what you're getting to see here is more of an analyst perspective in reviewing and evaluating the stock based on their third quarter performance. Now, we're gonna do something a little bit different this time. We're gonna get a little bit more technical. We're gonna open up the model to show you what's really driving our price target, what's underneath the hood, and see if you can keep up and give you more of that perspective, right? This is very technical. This is more of what we actually apply as professionals working on Wall Street. Now, if you're new to our YouTube channel, don't forget to subscribe, turn on the notification button so that you can continue to receive alerts every time we upload a lecture like this one. So with that being said, folks, let's get started and focus our attention to our screen. What you're getting to see now is a full-blown operating model on Apple, where we are putting together a revenue build-up, forecasting each one of the product category, what is the expected revenue growth on each one of those categories, then also what is the cost associated with those product categories, and build a full-blown consolidated financial model where we are projecting their sales, their profits, their earnings potential, and then we're applying different valuation methodologies. Discounted cash flow analysis, comparable company analysis, and we're also showcasing everything in something known as a football field, where we're taking a blended approach to figure out what is a reasonable valuation range for Apple. So in the previous lectures that I've been providing on stock analysis, we start with the first step, which is performing due diligence. The way we would do that is by looking at the company website, reading the press release on the quarter, or looking at the SEC filing 10K or 10Q document, and also reading the management and discussion section. Let's look at that briefly before we get started on this financial model. So let's show you what this will look like, right? So in the first part, performing due diligence to understand the situation, we will come here and we would read the third quarter press release. In addition to that, we will come here to the SEC filing and we will type in the company ticker symbol, click on search. It's not coming up. Let's see. Let's go back. No match. Let's see. Apple. AAP. Apple would have come up. Yeah, there it is. Okay. Click on Apple, search. And you see here the first filing, 10K. This gives you a very detailed breakdown on the quarter. And also you get to read what what Tim Cooter, the management, says about the quarter. So if you click on document, right underneath document, the first description, this link right here, if you click on that and open it, this would be part of your due diligence process. You would go through this 10Q form, and of course you need to familiarize yourself with it. But I'm just gonna show you what you need to pay attention to. You need to pay attention to item number 2, okay? Management discussion and analysis. You can also look at item number 1, which is the financial statements for the quarter. If I click on item number 2, this gives you a lot of information and insight into what the company, how the company actually performed. But let's look at one pretty important sentence right here. So third quarter, fiscal 2020 highlight. The first sentence tells you what was driving revenue despite the coronavirus pandemic, despite the stay-at-home orders. And it says right here, total net sales increased 11% or $5.9 billion during the third quarter of 2020 compared to the same quarter in 2019, primarily driven higher net sales of services, iPad, and Mac. Again, primarily driven by higher net sales of services, iPad, and Mac. Not the iPhone. Now they're starting to focus more on their accessory products, their wearables, and their services. This is primarily now what is driving growth. And when you really think about it, if you have an iPhone, you begin to understand how useful, how ingrained that device is in your life. Whether you want to communicate with your loved ones, whether you want to be productive with work, look at applications, the iWatch to monitor maybe your heart rate, your beat, your footsteps, how many calories you're burning. I mean, they are building so many products that are now fully integrated in our lives that they really have a very high usability. And again, we use them every day. That right there, it's a great product where we are all just using it. It's just part of our lives. And that's what Apple has been able to do. So very important that you understand the 10Q and how to read it, and also make sure you read the management discussion analysis part. Here also gives you the breakdown of each product category, and you can see, again, where the growth is coming from in the last 9 months of their current fiscal year, 2020. Look at this, 27% on wearables, home, and accessories. Then the second largest segment or product category, 16% growth coming from services. So you're seeing that there has been now a shift from high sales in iPhones to now wearables, services, home, and accessory products. So there's a shift happening in terms of what's driving top line revenue growth for Apple. So again, folks, this is the first part, understanding the situation of the company by performing due diligence. But I want to focus more on the financial model so that you can get to see more of the analytical work that we as professional analysts apply. So let's go back to the model. Here it is, and this is our cover page. The next tab is our revenue buildup. Let me zoom in here a little bit more, okay? And you can see different product categories. You can see unit sales for iPhones, Mac, iPad, wearable, home services, and their service revenue generation. I'm not going to spend too much on this. I've already come in here and I have updated most of these numbers, especially for the new estimates from Wall Street. See right here how we are comparing year-over-year revenue growth with Wall Street consensus. If I come back here to my case on the first page and change this to Wall Street case, you can see how my numbers are now a little bit more in line with the street, okay? And now I want to run valuation on a DCF basis and a comparable company analysis basis to see what would be a reasonable price target or where the stock should be trading at, okay? Now, you can also see right here the full-blown income statement. This is a circuit breaker. Let's restart our model. This is a full-blown consolidated net income. Here you have the balance sheet. Here you have the cash flow. And one thing I would point out on the cash flow is row 161. Look how much free cash flow Apple is generating. I mean, look at this. In 2020, this model, based on Wall Street estimates, is projected to generate $63 billion in free cash flow. The following year, $73 billion in free cash flow. I mean, think about that number. I mean, that number is bigger than some countries' GDP. And the importance of free cash flow is that the company has cash to either buy back their shares, pay a dividend, make an acquisition, reinvest in research and development without having to raise capital, without having to issue shares, without having to raise debt. This is a business that is now a cash-making machine in, up north of $60 billion on a yearly basis. It is unbelievable when you really examine and realize how much cash Apple is generating. And of course, this is a company that will probably be worth $2 trillion. They're getting close to that number. So I wanted to share with you what a full-blown consolidated model looks like and how we use this model now to perform discounted cash flow valuation or analysis. Okay, here we have supporting schedules like your depreciation schedule, different scenarios. Here we have a Romero mentoring case. You can see here, you could have an upside case, a Wall Street case, and a downside case just to stress test different scenarios. Here we have our Wall Street estimates. Now, this is all the analysts that reported their new price targets on Apple right after they reported earnings on July 30th and also the next day, the 31st. You can see a lot of different analysts here with different price targets, but if we take the average and the median, you can see that the average price target now on the street is $427. This was a 14% increase. On a median level, $440 with a 10% increase. Now, are these price targets reasonable? Well, we need to do our own analysis, and that's what we're gonna apply here. Let me scroll the way up, and right here we have our income statement. We have net sales, what the street is projecting. We have earnings per share. We have the current price of Apple as of today's close, 435. And then we're going to do two basic valuation methodology. We're going to apply EV over sales multiples and PE multiple, okay? Here we have 6 times for 2020 numbers on revenue. If we solve if we take the multiple 6 times their 2020 expected revenue, that gives us an implied enterprise value. We subtract our net debt, we get equity value, we divide it by the shares outstanding, and we get an implied share price. That's for this year. If we focus on 2021 revenue, expected revenue, 306 billion, okay? That's a 13% growth for next year's numbers. At a 6.5 EV over sales multiple, will give you roughly, wow, almost $2 trillion. That's 1.9 trillion in terms of enterprise value. You subtract your net debt, you get your implied equity value divided by your shares outstanding, you get an implied share price of $458. Now, if you look at PE multiple for 2021, a multiple of 31 times their expected earnings per share on a GAAP basis will give you $485 price target. Now, I'm just getting a blended approach here. I'm taking the median of both price targets, one from sales multiple and the other one from a PE multiple standpoint. $472 divided by 2021 earnings per share, that gives you a 30 times multiple or a forward multiple. I think this is, it might be reasonable given that they might be growing at 21%, but this is what is subject to debate or a discussion. Do you believe that they should be trading at a 30 times forward multiples, or you think they should be probably trading at a lower multiple? That's up to you. Do your own homework, do your analysis, and you could come up with your own reasons. But I'm just showing you the mechanics, the techniques, so that you can apply this at home on your own analysis or on any company that you're doing, okay? So this is very quick and dirty, a simple valuation methodology just using multiples. But if we take it a step further, okay, and then look at the industry, this is Apple right now. On a LTM basis, sales, they're trading at 6.8. If you look at EBITDA multiple, they're trading at 20 times versus the industry. So from a trading standpoint, they are trading above the industry mean and median. And again, why are they trading at a premium? Well, obviously, I just showed you the free cash flow that they're generating. I also talked about how they're shifting from high iPhone sales to now more home, wearables, accessory, and their service. So that is primarily what's driving the growth, which are more profitable revenue generating products than just making the hardware of an iPhone. Look here, their revenue growth on a revenue, EBITDA, EBIT, and net income growth on a 1-year basis, right? Look at that, higher than everyone else in the industry. While everyone else or their comparables, according to Cap IQ, S&P Cap IQ, this is where I'm getting the data from, they're growing above everyone else. So you see here that you can justify a premium for Apple, okay? And this is right here, old comps that we were using when we first started building the model on Apple. And by the way, folks, this model was actually put together by a college freshman in our analyst training program. And this just showcases, how in depth we are in our program, and this is valuable insight into the analysis process of determining whether this company is good or not, and is it a good investment. And you have to understand the fundamentals and what's driving that growth and project the cash flows to see what would be an implied share price. So in this tab, we're showing you a discounted cash flow analysis. We're applying two methodologies, terminal EBITDA and perpetuity method. And right here, this sensitivity analysis table is just giving us different ranges. But I want to pay our attention here on our football field. This is what I discussed earlier, our blended approach of taking all the valuation methodologies and then coming up with a reasonable range. This is what you're seeing right here. So here is the low valuation range and the high valuation range for each methodology. Sales multiple, EBITDA multiple, PE multiple, discounted cash flow analysis. You take the average and the median, and this gives us reasonably where the stock should be trading at, all right? And then we have a football field. And a football field simply represents all of your valuation methodologies. That's what this is saying. And when we see the range or where the stock should be trading at, we can say between these two right here. See here, selected range? How do we come up with this? I'm just taking the median of my average and median. So this right here should be actually the median. He was actually, let's see here. He was linking. This is, I mean, you could do this as well. Like I mentioned, you could take the average of this and just take a blended approach, or take the median. All right, here we go. There. It doesn't move the needle much. But between 358 and 409 should be a reasonable valuation based on the current Wall Street estimates. And if we take this square rectangle right here, this will show us where the stock should be trading. We could draw 58 to 409. There, okay? You can see it on the horizontal axis, this is the share price. And on the vertical axis, we have each valuation methodologies, right? The low valuation range and the high valuation range, okay? Now let's draw where Apple stock price is currently at right now. Their stock price is around 438, which is outside this valuation range. It's outside of it, right? It's outside of this valuation range, which might be an indication that the stock might be overvalued at this point, or the price move has gotten ahead of itself on a valuation basis when you apply these different sets of methodologies. What is the price target that this model had projected on a Wall Street case basis? 405. What was the upside case that the student that put this together had? 435. And of course, the downside case was 375. Let's open up the chart to see where Apple stock price is at right now. Here it is, right? So obviously here's the gap, the pop on earnings, better than expected. Here's today's price action, okay? So will you be a buyer at these levels? Well, if we map out here, the price target range was around what? Or the valuation range was around 409, okay? And let's pull up the model again. So 409 and 358. Let's pull up the chart, 358. Let's take another horizontal line, 58. Here it is, 57, well, you get the point. The stock is outside of this range, right? It's above it. So that might be an indication that maybe if you want to buy it, the risk is greater to the downside because a lot of the momentum and a lot of the possibilities are already priced into this stock. So chances of this coming back down here, I think is higher than it continuing higher. So you have maybe case number one, okay, it pulls back into the valuation range, or case number two, it just continues higher, further extending it. But let me give you a different perspective. This is a daily chart, okay? And keep in mind that we have come quite far from our March lows right here, right? The stock is almost, it's double from March lows. But let's look at a bigger time frame, right? Because what I'm seeing a lot right now in the market and in social media is a lot of new market participants saying that this is just going to continue higher. And that is not the case, folks. Look at a weekly. Will you be buying at these highs right here? Okay. Look at the monthly. Will you be buying at these highs right here? Look at what happens with stock price. They never go straight up. They go up, comes down, profit taking, shakes off the weekends, then move up again. Then comes down, profit taking, shakes off the weekend, and then it resumes its trajectory once we're in a bull market. And if the fundamentals are strong enough with the stock, look here on a monthly basis. Goes up, comes down, goes up, comes down, goes up, comes down, goes up, comes down, goes up again. What do you think is going to happen? What do you think is going to happen? Chances are, or the risk is greater to the downside. The risk reward now has shifted to the downside rather than it being to the upside. I hope this gives you a different perspective to look at the bigger picture, not at the daily, but look at the bigger picture. Because if you just buy on a daily and continue chasing up here, you're gonna be upside down in your initial position. Then you're gonna end up, getting hurt. It happened here. Will you be buying at the highs here? It happened here as well. Do you want to buy here? Same thing here. Same thing here. So this is what I'm preparing you for, to give you a different perspective. Look at the bigger picture. How do you apply fundamental analysis from a analyst standpoint and add more methodologies or more techniques to your investment decision process than just buying a stock. There's a lot more to that process. And once you understand the fundamentals of the business, then you can play or ride a bigger bull move like this, right? I mean, look, we can draw an uptrend. Could draw one uptrend right there. We could draw another uptrend from here. And now a third. So will you be chasing up here? Absolutely not. And now I have a reference point, which is this, of where I would like the stock to at least come back down. And if we are longer term bulls on the stock, because obviously you saw the free cash flow, they're still generating massive free cash flow. The prudent thing to do would be to wait for a pullback and then ride the next wave. If you are chasing at these levels, look, you missed the move. The biggest return would have been buying it down here, when there's fear, when there's panic, when there's hysteria. Have you heard the saying? Buy them when they're crying, sell them when they're yelling. Yeah, right now everyone is yelling and screaming, buy, 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 buy. I'm giving you a warning. Don't chase at these levels up here. Same thing if we look at the Qs, QQQ. See here, we're at all-time highs. We're at all-time highs. Will you be buying up here? No, I personally think that the risk is greater to the downside now. And I'm actually waiting. So this is what you get to see when you zoom out and look at a bigger picture. 40,000 foot flyby. Switch from a daily to a weekly and a monthly time frame. I think you're going to be surprised of the amount of information that a monthly chart reveals to you and allows you to see where the stock is at. And you can make probably a better decision. Do you want to buy at these highs where the risk of it rolling over, profit taking is higher? That's your decision, but I'm just trying to give you a difference of opinion, a different perspective, so that you can add it into your own analysis. Maybe you have biases and you have blind spots the same way I do. And maybe I'm wrong, right? But this is just sharing my opinion, sharing a little bit more of the methodology and the process behind stock analysis. And one of the things that I actually do myself personally, but also with the students in our analyst program, where they're learning exactly this and becoming a lot more methodical behind their decisions. So let's go back here to Apple. Okay, here it is. So this is where we think the stock should be trading at. It's outside of this range. Hopefully when it comes back, if we get a pullback on the stock and then it consolidates, builds a base, before it moves higher, at least it'll give you an opportunity to probably buy it back at a lower level rather than buying it up here and then rolling back. So I think this is something that you should be aware of if you're going to buy it, and add all of the perspective into your decision-making process, and then try to put the odds in your favor. So going back here to the model, okay, even in the upside case, 435, it's already there, okay? And the upside case is best case scenario, so it's already there. And I'm sure that other hedge fund managers, other pension fund managers, they're doing a lot of this analysis. And of course, they have more information than me. They have more analysts than I do, and they have access to expert networks. They have access to the supply chain management. They can talk directly with key managers at the company to make better predictions or more accurate predictions than what our students are making right here with the limited resources or information that they have. But at least you're getting to see the process. At least I'm sharing with you the analytics behind that decision and how you can prepare yourself by learning more of these methodologies to make you a better investor and become smart money, not dumb money. All right, folks, so it's a little bit, this session today is a little bit different than what I'm normally used to doing, where I'm more methodical and I walk you through the whole process. But today I wanted to share more behind the hood. Today I wanted to share an actual model and how we apply the forecast, the revenue buildup, the projections to come up with price targets and a reasonable valuation with the stock. And then of course, combining it with charts. So I hope you find value in this. I hope you can incorporate it into your own decision-making process. And if this gets you closer to being a better investor, a better analyst, then great. Then I've done my job as an instructor in sharing more information, and I hope you gain one thing out of it. All right, folks? So with that being said, stay safe, take care, and I'll see you in the next one.